Hi guys, this is Investing with JYK, and today we'll discuss Uranium Energy Corp. It's another uranium miner. For disclosure, I own some of their shares. So, Uranium Energy Corp is a US-based uranium mining company, and I've made a video about the uranium market, and since then, I think there's been one or two more Japanese new restarts. The Chinese came up with their goal of I think within this year there will be a couple, like 5 that's gonna go online or something. But overall, from what I read, is that the mine output, global mine output, is going to go down to something around 144 million pounds, and the global demand will go up to about 194 or 96, something like that. So I still maintain my conviction that uranium price increase is a problem of when, not if. And okay, so let's look at this company. So let's first look at their actually, let's first look at their asset base, right? So let's look at at the end. All right, so what do they have? They've got a bunch of projects and near Texas, and these are all ISR projects. ISR is an in-situ recovery. Essentially, you stick a couple of pipes in and you pump either acid or alkaline. In US, it's mostly alkaline. In Kazakhstan, it's actually acid, and that will react with uranium oxide, and that becomes soluble. And so you pump it in from one, and then it has to be permeable rock. So then you get like the other ones that sucks up the what they call pregnant solution, and that goes into a processing plant where the ion exchange happens with some resin, and that resin will absorb all the uranium, and these resin will be then sent off to processing plants, and then the water is recycled to put in more alkaline to repeat that process. So it's very much like a water processing plant, and the production characteristic is that it's a bit like shale oil. So initially it has a huge when you start mining, its production is at the highest, and then it will drop off fairly quickly. Then you have to keep moving the mine fields, the ISR fields, essentially. And but the advantage is obviously it's really cheap, in the sense that it's doable in US for cash costs around $20, and if you're in a place with lower labor costs like Turkey, I've seen ones as low as 16. But these are cash costs, like sustaining cash costs. It doesn't account for exploration, doesn't account for financing, any of that stuff. And it's not very dependent on the grade of the ore. So, and obviously, the reason it's cheap is that you don't have to dig up any rocks. You just kind of leave it there, and then you pump water in, you suck water out, and that's it. Okay. So that's their main thing, actually. So I think they've got Goliad and Palangana, both permitted, and they also have they have a processing plant that is also permitted for, I think, 2 million pounds a year. So 2 million pounds, if you think about it, that's 1% of global output, right? So it's not tiny. And I'm not sure they will hit it, but if they do, that's actually quite substantial, because the US itself produces something like 2% of the global output. So that basically would almost increase the US output by 50%. Now, recently, we'll discuss later, but they also have one project they're expanding, this Burke Hollow thing. And then recently they also acquired this project. So again, it's in Wyoming, but it's another in-situ recovery. And you can see this one is much larger in terms of tons, and also in terms of the actual resulting uranium. So this is a number of ores. And the grade is lower, so I assume the cash cost will be slightly higher, but it's not. ISR really isn't too sensitive to the grade. I mean, if you do 0.001, then yeah, but anything above 0.03, from what I know, is somewhat reasonable. Like, for example, this Anderson thing here, this thing is not gonna get mined until the price reaches, I don't know, maybe. Well, let's just think about it, right? If assuming this is open pit, you can get 0.03% per of uranium, so 1,000 kilos times 0.03 divided by 100. So you're looking at 300 grams of uranium. And 300, so 0.3 kilo to pounds is 0.66. And if you, so the cost of open pit mining is typically $20 per ton of ore milled. But since it's uranium, this is all this radioactive stuff, maybe it's going to be higher, so like 25 per ton. So 25 divided by that. So at least this thing is going to be like $40 in cash cost. And if you refer to my older video, we have Chemical that has the McArthur River mine and the Cigar River mine. These are like 18% or some, crazy numbers. I think like 6, 18, like 10. These are crazy numbers. That for a single ton, you get like, at the current price, you can get more than $100, like $200+. These are underground mines though, so the cost per ton mine is different, and that's actually a common thing with the Athabasca Basin mines. These are all underground mines, and it's in a really cold place, so it's not really nice for people to go there. So you have to pay people a lot to even be there to mine your stuff. Anyway, so just because they have this somewhat large amount of, so this is like 17 million pounds of uranium. This thing is not going to get mined until things turn to like 50, 60 dollars per pound. So don't count on this. And yeah, all these are still in really early stages. So when the price increases, these are not going to get mined. They still have to drill and all that stuff. They might get the money to drill by then, but don't hold your breath. And here you got the Paraguay ISR. That's you got this guy, which is mostly drilled, and grade is reasonable, and it's in Paraguay. I don't know anything that's crazy in that country, so it seems reasonable. And this one will get, this one I think if the price is reasonable enough, they will get produced. So that's their portfolio. And compared to chemical, obviously there's no comparison. If you compare to even like UUUU, the energy fuels, their resource portfolio is smaller. But energy fuels has less in ISR, more in hard rock. So that's another consideration. Okay, so that's their projects. Oh, there's actually one more thing. They have some, very interestingly, you got this titanium project. I know this is a uranium, titanium, right? This is a uranium company, but they did something really good, as in they purchased an option to purchase a Paraguayan titanium deposit. So, you know, back then the price, what the hell is going on? Okay, back then when they signed that option contract, it was super cheap. Titanium has since gone exploding in price. Look at this. You know, this has just in 1 year it has gone from, they signed it in 2016 and they exercised that option in 2017. I think the price went from something like 1.25 to $1.5 is probably going to increase even more because the supply is tight at the moment. And you can see that really this is, do we have anything that's 5-year maybe? Right. So they basically signed somewhere here, and then you can see the price has gone up a lot from 3.5 to $5. So that was a good deal. And if you look at this is TO, yeah. So let's just calculate how much money is a ton of ore, right? So they got 7%, I think, in here. They have about a 7%. Let's ignore the iron for now, just a 7%. 7.41 divided by 100, obviously, times the 4.94 billion times 1,000,000,000,000. That's how much titanium they have, times the price, which is, so these are tons, and let's turn that into kilos. And let's see, what do they have? This is per pound, so let's turn that into pound. All right, so you got that many, 10 to the 11th. And then the price was something like 1.5. Right? And then you divide by 10E9, that's a billion. Well, I think it's 1E9. So they got, supposedly, am I making a mistake in here? I think I'm making a mistake here. Can't be 100 billion. Let me try it again. 4.9. Okay, let's do everything in billion. 4.94 times 0.741 times the, so that's tons, right, times 1,000. Well, let's do tons to pounds. So that, okay, that many pounds. Okay, that's billion pounds. Each one is 1.5. Huh, that is true. There's a there's a shit ton of titanium in there. But obviously this is you have to calculate the cost of processing these ores. So each ton typically is $20 if it's open pit. If it's going to be like $100 plus if it's underground. So assuming these are open pit, you're looking at 4.94 times 20. It's yeah. So if it's open pit, you got $200 billion worth. Obviously, you still have to build everything. I'm not sure. I looked at the map. It wasn't like ass of nowhere, but it doesn't seem super developed around it either. So it might be 200 billion, but whatever. Let's say even if it's worth 200 million, this company is only selling for 200 million. So I really don't care too much. You know what this thing is, and they're not going to develop this mine. They're probably just going to sell it to somebody. So, and I haven't read the resource report on this business, so we don't know exactly how accurate this thing is, this estimate is. So that's the interesting thing about them. They have this thing. They have this, this titanium business. This deposit might be worth as much as the company's market cap itself at the current price. And then they bought it for super cheap, and that's a recurring theme. Okay. So the other thing with resource companies is, are they going bankrupt? Okay, so since uranium companies are all losing money, are they going bankrupt? Balance sheet. All right, let's see how long they will survive. They got 12 million in cash, 10 million, so $22 million basically. The rest, inventory, whatever. Nobody's going to sell that. They're not going to sell their inventories at this price. So $23 million. And these you really don't want to be selling. You want to be buying at in this market. So none of this will be liquidated. And they got liabilities of 2.5 million, and then they got a long-term debt about 220 million. So you can see that this long-term debt is, I think, is partly due in 2019. Okay, so these are this one potentially can be the one that makes them go bankrupt. And you say, oh, but until 2019 they should be totally fine because they have $24 million in the bank, and they can pay this off. Hold on a minute. So here is what I don't like about this company. If you look at executive compensation, right? So whatever this says, da, 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 da. Okay. Here is the thing that I don't like. In this market, the CEO is getting $500,000 a year. Right? And then if you add these up, I mean, stock awards at least don't burn their cash, but we are paying for it as shareholders. Option awards, same thing. So you're looking at, let's just look at the cash portion, right? So 344,624, I don't know how I can come up with that weird number. 260 plus. The rest don't get paid that much egregiously. I mean, they get paid about 100K each. So let's say that there's an executive vice president get 200K, and this Katsumata guy left. So you're looking at 100K. Oh, let's just do it properly. 78000 plus 15000 plus 100489 plus 35000 plus 188003 plus 30000. All right. Look at this. $1 million in executive compensation, and these are essentially 4 people. They're paid $1 million. So by the time of 2019, $2 million will be gone. That is, I don't like this. But I do also like it in some ways for what they do. Oh, the other thing to compare is, think about the Texas Roadhouse guy that I have made a video on before. The CEO there gets paid $550,000 a year, which is like nothing compared to his stock holdings, right? He had like hundreds of millions of dollars, like $200 million, I think, in Texas Roadhouse stocks. This guy gets paid $500,000 a year in cash, another $500,000 in stocks, and he owns somewhere around here. There's stock ownership. Yeah, he owns $4 million, 4 million shares, and multiply by the 1.5 or ish stock price, you got 6 million. So the portion is clearly different. He's more of a employee than a owner. I mean, 2.8% is still significant in a sense. So if the stock explodes 10x, he really like that. But again, it's just a proportion. I really don't like this proportion. All right, and then in total, the management only owns 5% of the entire company, so that I don't like. Okay, so let's talk about what I like about this company. Other than their project, their projects are reasonable. They have fast ramp up times. Most of their stuff is permitted and ready to go. Right? So if you look at like the market really went really crap since 2014 actually. I think in chemicals, chemical.com, I think chemical. Yeah, chemical has a price chart. Uranium markets. Uranium price. Where uranium price? Yay. And if we go somewhere to 2010, 2010 is when Fukushima happens, right? So at $40, you know, some still can make money. They can probably still make money. But by here, it really got really bad, 2016 onwards. And if you look at what they've been doing since 2016, they got a mine permit for their Burke Hollow mine project. So that's important. These take super long to get. So by getting it when times are bad, when you focus on that, that's pretty good. And the second thing they did was they stopped production. So that was some gutsy decision. And they got some financing, whatever, and which is important. They don't want to die. And since then, they also try to. They in 2018, I think this is just broken. In 2018, they got another project, but this one is a long shot. It hasn't even been fully explored. It's in Athabasca, and it's not really their thing. This is probably going to be an underground mine, even if it gets built. So I don't really consider that much. But they did it with 0.1% dilution. So that's the important. And we'll see that once we get to 2018, sorry. 2017, you see what they did. They kept drilling Burke Hollow and then discovered more resources. They bought Reno Creek. So the Reno Creek project you saw previously was bought in 2017. They bought it really cheap. And they bought it for, where was, yeah, they bought it for essentially $3 million plus 2 point something, so $5 million around in value. And the guy that purchased this stuff paid a lot more than $5 million. I will I don't know if I don't remember if I've talked about this before, but Energy Fuels is the one that lost hugely to this. I have no idea what is he thinking. Why you would be selling assets at the bottom of the cycle? Like, do whatever thing, dilute your shares or whatever. Like, you should not be selling assets. You should, for all these cyclical companies, cyclical industries, the winner usually are the anti-cyclical players. Essentially, the ones that don't buy at the top of the cycle and buy when everything's crap. So even though everything's crap, you're not making any money on any of your assets. You keep buying more assets. So they seem to get the idea. So which is why I really like them. They've been buying and buying and buying, and here they combined essentially the entire map. And look at this. They just got the Energy Fuels lots, right? And let's look at the others. What else have they been doing? Yeah, so they just acquired that, and it's fully permitted, fully licensed too. It's not. I'm not actually not sure. I have to look things out. I'm not sure what the difference between fully licensed and fully permitted is. Permit. Oh, I think it's the same thing. You can produce up to 2 million pounds of uranium a year. Yeah, so that's good. And what else? They kept on drilling, and they bought this Alto Paraná titanium project, which might be worth the entire company at this point. And these are just BS. And then yeah, and then this is the thing. They first bought Reno Creek, then they bought North Reno Creek, and then they combined them. So they just kept on buying, kept on buying, and kept on buying. And I really like the way he manages this company in terms of he buys at the bottom of the cycle. And I think it has, even though uranium hasn't increased in price, a lot of value has been accumulated in this company. And every time he buys them for very little dilution, actually. Even though he himself kept on diluting the company by issuing himself stocks and whatnot. But at least the acquisitions that this Amir Adnani guy, the CEO, are very logical. So yeah, so that is essentially what I think about UEC. It's a U.S. company, which brings its own unique benefits because if Trump goes crazy and says buy American uranium, they will benefit. They have decent projects with decent deposits. They have a titanium deposit that might be worth a lot of money at this point. The CEO seems to make all the right decisions by advancing projects, buying assets at low uranium prices. And what I don't like about them is comparatively, they are more expensive than Energy Fuels in terms of, let's say, enterprise value per pound. Energy Fuels presentation has a slide that shows that they are actually like the cheapest. The other thing I don't like is the executives are getting paid too much. I don't think, even though they're doing the right things, I think they're still getting paid too much and their ownership is too low. So yeah, make your own bets. I own some. I think, if the bear markets last for even longer, as long as they don't go bankrupt, it should be okay. They should give you pretty good returns. And oh, one more thing which I forgot. They're not very likely to go bankrupt. Even though you can see they have yeah, let's go to the debt due. There's a long-term debt. Here you go. Yeah. So this stuff is due in 2000. You have to start repaying in 2019, and I think it's due in. I forgot where that is. Sorry. Long-term debt. Yes. So now it's like 2020, but they kept on extending it. And then the reason they can keep on extending it, you can see like, half of it due in 2019, another half in 2020. The reason they can keep extending it is they're on pretty good terms with the lenders. The resource people like the CEO a lot for some reason. And for example, like the Sprott resource group and the Marine Cartuza people, they like the CEO a lot. So I think they will keep extending him credit for the foreseeable future. Okay. Thanks all, and if you like it, like the stuff I do, please subscribe and click thumbs up. And what I try to do is basically show you how I do research, and so in the future you can do your own research about companies.